So we're now going to pivot into business owners. And so I'm going to run through our consideration for business owners because it's a different topic, right? We all have to file a personal tax return. So we have personal strategies that applies to everybody. When you're a business owner, though, you have other returns, right? You might have an S Corp return, a C Corp return, an LLC. You have different types of tax returns. So there are considerations that business owners have that not everyone else has. So this focus is going to be on considerations for business owners. So at a high level, we do have a tax philosophy here as well for business owners. Key ideas: pay yourself a market-based wage. That's really important. Too often we say business owners are not paying themselves a reasonable compensation, and that has a ripple effect through all the planning. So we want to make sure you're paying yourself a market-based wage. Number two, business owners, focus on being profitable. Don't just spend money to avoid taxes. I can't tell you how many times people will rush to make a decision at the end of the year to get a deduction just to avoid taxes. If you need the deduction, if you need whatever you're buying, an equipment, a vehicle, whatever you're buying or spending money on, if you need that to help grow your business, by all means. But if it's just for avoiding taxes, I hate it. Like, it's just a bad idea. Paying taxes is the goal. That's why you're in business, because that means you're making more money. So if you're taking the risk to be a business owner, the goal is to make more money, which by definition, you'll pay more taxes. Number three, be careful about accelerating deductions using Section 179. So again, if you're in the 24% bracket or lower, it might be best to pay the taxes now. Now, this is going to depend on a lot of things, like your current cash flow. Can you afford to pay the taxes now? But oftentimes, what I hate seeing is that as people are building their business and they're in lower brackets, they accelerate their deductions to get the write-offs today. And then in future years, when their income jumps and now they're in a 32% bracket or a 35% bracket or a 37% bracket, they don't have those deductions at those higher rates. And that's when I want to use them. So those are kind of our key ideas of just be mindful around this. And again, we take the same approach with business owners, is we want to make sure we lower their lifetime tax liability, not in any one given year. Some of our big solutions that we help our clients with: payroll optimization, and I have a few slides on this, adding spouse or children to payroll, retirement plan design, how to effectively do that, and creative strategies like the Auster Rule. So this is just a summary layout of some of the different strategies, effective planning strategies for business owners. So the Auster Rule strategy, which is the second one over from the left, is IRC Section 280AG, and basically it allows you to rent your house to the corporation up to 14 days tax-free, and that oftentimes can save about $10,000 to $25,000 in tax savings. Payroll optimization by hiring spouse and children and doing a reasonable compensation analysis. That'll save $5,000 to $20,000, depending on how many children. And then retirement plan design can really run the gamut of between $7,500 and over $100,000, depending on the types of plans that we look at. So by being purposeful in these three areas, the tax savings can really add up. And again, it's being thoughtful about how do you implement them. So that was a summary overview. I'm just going to go through real quickly. You can see on this slide. So basically the ability of a homeowner to rent their house out to their corporation, and with the business purpose of doing what we call a planning day. And you can see on this example, and this is not a recommendation necessarily of the daily rate, because you need to get a comparable daily rate. But if you rent your home out for 14 days at $3,000 per day, that would create $42,000 that could be deducted from your corporate tax return, lowering your income by $42,000. And if you're in the 40% bracket, that would save about $16,800 annually. So essentially a tax-free distribution out of your company. However, there has to be a business purpose. You have to do documentation. So there are hoops to jump through, but it's a great planning strategy, especially if you will embrace this idea of a monthly planning day. The next option on here is payroll optimization. Again, there's, looking at the idea of adding spouse to payroll. You can substantially increase your retirement plan contributions, which can save taxes. Also, adding your children to payroll who are doing work in the business. A lot of times we see that as, junior high, high school, college. That's when children will get involved with the family business. Obviously there's big value to the children, benefits at working at a young age, benefits of understanding the family business. And then from a tax perspective, you get some deductions there as well. And you know, it's around 5,000 per child per year in tax savings. So there can definitely be some benefit there. And you know, again, then we get into retirement plan strategies. One of the benefits of obviously having spouse and children on payroll is for your spouse, you can max fund profit sharing. You can consider funding a Roth 401k potentially for you and your spouse, which, you know, means you could put over 60,000 per year in Roth. For your children, you know, you have the ability to have that earnings paid directly for college, maybe go into a 529 college account, or even, I think one of my favorites is the ability to fund a Roth IRA early in life. We did some math that said, if you funded a Roth IRA for your child at $6,000 per year from age 16 to 22, so a 7-year funding window, that at a reasonable growth rate or market-based growth rate, that they would have over $2 million by the time they're in their mid to late 60s. So pretty powerful stuff. Again, a lot of the business strategies, we just want to be more purposeful about the decisions that we make. I hesitated to have this slide up here. There's something in the current tax code called a QBI deduction, which is a qualified business income, which basically means that 20% of your profits from your business might be eligible for a deduction, which means essentially that 20% would be tax-free. Now, there's a bunch of different nuances here, and I'm not here to necessarily make you an expert on this, but it's really important to know, do you qualify? And it's based on a few things: the type of business you're in and the amount of income. So if you're in the right business, it doesn't matter how much income you make. There is limitations based on how much you pay yourself. That's why doing paying yourself reasonable compensation and analyzing that's really important. If you make too much income and you're in the wrong type of business, then you basically will get phased out. So the long and short of this is really important to know where you stand, because there's tons of planning techniques. I have multiple case studies on scenarios. I'm going to give you two. So we had one of our clients came in. It was after the year was over, and had a really good income year based on the industry he was in, did not qualify for this deduction. And so we actually set up a cash balance retirement plan. He was able to put over 100,000 in the plan and made him eligible for the QBI deductions. So he was able to save over 60% in taxes on that example. Now, again, that's just one example. We also had a prospective client came in. I reviewed their taxes for them, and the accountant prior did not pick up that he was eligible for a QBI deduction. This was a high earner. He was making $3 or $4 million a year. And basically I looked at the tax returns. I'm like, something's wrong here. You're not getting the QBI deduction. So long story short, went back, a new CPA reviewed tax returns, last 4 years, could only amend the last 3, and it was over $600,000 refund because the wrong profession was selected for QBI. So we don't find that kind of a mistake that often, but it was definitely one that was worthwhile mentioning because we do catch this stuff. So QBI deduction is really powerful, and there are ways you can navigate it, especially if you're in a higher income situation, but that's where the thoughtful planning comes in. Other thoughts for business owners. So good example is if you have a business where you're going to have what's like a large net operating loss, so you have a down income year. One of the things we love doing is we'll do a Roth conversion. We had a client last year who was going to have a big operating loss, and so we were able to convert over $1 million on his Roth without any taxation because he had that loss. Now, there's probably some nuances that's not perfect, so it doesn't work in every situation, but the reality is he was able to convert over $1 million in the Roth, and he could use the operating loss to offset this. Again, that's a really important conversation to have with your tax professional, but obviously that's really powerful because that money will be able to compound, you know, over the next 20, 30 years. The next bullet point on here is in California, we have something called the PTE tax, which is the pass-through entity tax. So basically, California put in place that since there's this cap of $10,000 on state and local tax, that you can pay your California taxes that would be owed based on the profit of your corporation from your corporation. And by being able to make that tax payment from your corporation, it reduces your taxable income at the federal level, therefore saving federal income tax. So real simply, let's just say you owed the state of California $80,000 because you had a business that earned $1 million. You pay that $80,000 from your corporation, and assuming you're in the 37% tax bracket, you're going to save, north of $30,000 in federal tax. We've seen this get missed a lot of times where we'll have prospective clients come in and, oh, are you doing the pass-through entity tax deduction? And it's kind of a deer in headlights, not really sure what that is. We go through it with them and they're not doing it. So we're not seeing that as much. Hopefully it's not anyone on this, listening to this video or on this webinar. But it's definitely something that we're seeing, that it's just, staying on top of these issues. And then again, something on the horizon is, Congress has discussed imposing a 3.8% surtax on S-corp profits. So is that something on the horizon as well? Okay, closing thoughts, essentially the same as on the personal side. Again, we've been in a pretty favorable tax policy environment. Really want to make sure we're making the right decisions to hedge against future tax increases. Again, be careful about accelerating deductions now, because we might be going into a higher tax environment in 2026. Make sure you work with your tax professional and estate planning team to make sure you implement the proper strategies for your business and for your personal needs.